Hello, Faiza.
Yes,
Hello. Yeah, you can go. You
yes,
are good. Yeah, it's fine. Thank you.
thank you. Hello, everyone. Welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Press Cooper. Today, we are discussing qualifying group relief. Now, for those of you who have been joining us regularly, know that we have been discussing various topics every week. So, if anybody is new here or any of our regular participants who would like to revisit any of our lectures, previous lectures, they are available on our YouTube channel with the handle Crest Cooper. You can, if you have any questions regarding these webinars, you can always email us at info@crestcooper.com and we will be happy to assist you with the query. So today we will be discussing the qualifying group relief. So as you know that last month in April, the qualifying group relief guide had also come out, and FT has been now regularly taking out a lot of guide. I think recently also we see the investment fund manager guide has come out now in May, and the frequency of the guide is increasing. So today we will be discussing the qualifying group relief guide. So this qualifying group relief, like there are many reliefs available in the corporate tax law. One of them is the qualifying group relief. This relief specifically is for members of a qualifying group. Who are the members of a qualifying group? How can they be form this qualifying group? We will discuss this also. But this under this relief, which is available to the qualifying group, assets and liabilities, they can be transferred between the members at book value. So basically, it's tax neutral. So when this happens, this transferred book value, then it doesn't result in any gain or loss. So the idea behind this relief is basically because from the group perspective, you can say that at group level, the ownership remains with the qualifying group, so it's not impacting the group level. So that is why under the corporate tax, this relief is available to the members who are part of the qualifying group and who are transferring assets and liabilities, because at the group level, this ownership will remain with the group and it doesn't change. So that is why this results in a tax neutral transaction. So now qualifying group. So when we are talking about that member of the qualifying group can transfer these assets and liabilities between each other for this tax neutral transfer. So there are certain conditions which need to be met so the you can be part of a qualifying group. So these are the 7 conditions that need to be met for any transfer or transferee, or you can say any juridical person to be part of this qualifying group. So what are these conditions? So the conditions are that the transfer and the transferee, they need to be juridical persons. The transfer and transferee need to be taxable persons. Either the transferor or the transferee needs to have direct or indirect ownership of at least 75% in the other person, or third person needs to have direct or indirect ownership of at least 75% in both the transferor and the transferee. Neither the transferor nor the transferee can be an exempt person. The transferor or the transferee cannot be a qualifying free zone person. The transferor or transferee, they must have the financial year ending on the same date. And the transfer and the transferee must prepare the financial statement using the same accounting standard. So all these conditions, they need to be met before you can be part of a qualifying group. Now, all these conditions that we're talking about, these are like pre-transfer conditions. So only if these conditions are met and then you are part of a qualifying group, then only this relief will be applicable and this transfer can happen at book value and be tax neutral. So let's discuss some of these conditions in more detail. So the first condition and the second condition we were talking about, that the transfer and the transferee need to be juridical person, they need to be taxable person. So what is juridical person? A juridical person is basically an entity which has a distinct legal personality from its owner. So for example, like a natural person who is not separate from their owner, like a sole proprietorship, sole establishment, this legal juridical person is someone who is an entity who has a legal personality, which is not the same as the owner. For example, like limited liability companies, we discussed this before, like private joint stock companies, private companies. So all of these LLC companies, they are basically juridical persons. So for the first condition to be met is that you need to be a juridical person. So for example, natural person, sole establishment, they cannot be part of a qualifying group. The second is that they need to be taxable person. So taxable person, they can be either resident taxable person or non-resident taxable person. What is a resident taxable person? Those are the entities which are incorporated in the UAE. So this will include free zone businesses, but it will exclude exempt person. So we have discussed later in the condition that you cannot be a qualifying free zone person, but you can be a free zone person. So the company can be incorporated in the free zone. It might not be meeting the condition to be a qualifying free zone person, or it might be meeting the condition, but it has opted to be taxed at the standard rate. So if that is the case, this free zone person can still be part of the qualifying group as long as they are not qualifying free zone person. But an exempt person, they cannot be part of a qualifying group. Then the entities which are established in a foreign jurisdiction, but they are managed and controlled from the UAE, those are also resident juridical person. A non-resident juridical person would be like a permanent establishment of a non-resident person, a branch, an office, an exclusive agent. So those are considered as the non-resident juridical person can be part of this. If there is a non-resident who has a nexus here or is earning state source income, they will not be part of this qualifying group. So moving on to the second condition, the ownership condition. So now when we talk about the ownership condition, we say that there should be 75% common ownership. Here we can break it into three parts. So either the transferor, they must directly or indirectly own at least 75% equity in the transferee, or the transferee, on the other hand, the reverse, that they might have directly or indirect ownership of 75% in the transfer, or a third person might have, direct or indirect 75% ownership in both the transfer and transferee, so the common ownership. So when we are talking about indirectly owning, here there can be certain cases. So for example, if a transferee can directly own 75% in the transferee, if they don't directly own, then the transfer might own it indirectly through a subsidiary. Now, this subsidiary might be 100% owned subsidiary. In that case, for example, if the subsidiary owns 75% in the transferee and the transfer, it's a wholly owned subsidiary, the transfer will have 100% ownership. That means that 75% condition will be met. But for example, if it's not a wholly owned subsidiary, it might be that the transfer has 75% shares in the subsidiary, who in turn is holding 75% share in the transferee. So in this case, we need to see the effective ownership. So if, for example, in our example where it's 75% owned subsidiary, in this case, the effective ownership will not amount to 75, but this will amount to 56.25. So this will not meet the condition. So it has to be enough of ownership in the subsidiary so that the effective ownership in turns is 75. Now this can be reversed also. The transferee can have the direct ownership in the transfer of 75, or like we just gave the example of the wholly owned subsidiary or the part owned subsidiary. So indirectly, the transferee can also have the ownership in the transfer for them to make this ownership condition, to meet this condition. Now, if this is not the case, then they have allowed a third party who can have this direct or indirect ownership of 75%. Now, please note here that they have mentioned a third party, meaning that they have not said that it has to be a juridical person. This third party can be a natural person as well. Now, when we are talking about ownership interest, we mean equity or any similar interest, for example, partnership interest that carries right to the profit and liquidation proceeds of the taxable person. That is transfer the transferee of both, where the transfership interest is held by the third person. So this is just the example of ownership interest. Now, before we move on to the transfer, so we have covered the first three conditions in detail. Now, we already discussed that transfer and transferee cannot be an exempt person. So this cannot happen. The transfer or the transferee cannot be a qualifying free zone person. Now, just one thing to note here, that although the exempt person and qualifying free zone person cannot be part of the qualifying group, but if for the ownership, when we are doing 75% direct or indirect ownership, if it is an indirect ownership, and that subsidy that we were just talking about earlier, through which they're owning the 75% effective ownership in the transferee, that subsidy can be a qualifying free zone person, it can be an exempt person. They are not part of the group. It is just that the effective ownership is being calculated through those subsidies. So they can be exempt person or qualifying free zone person, but the transfer and the transferee themselves cannot be a qualifying free zone person or an exempt person. And like we had just discussed, that a qualifying free zone person, if they are basically not meeting the condition. They are free zone person not meeting the condition to be a qualifying free zone person, or they have chosen elected to be taxed at the standard rate, they can be part of this qualifying group. The sixth condition is the transfer and transferee must have the financial year ending on the same date. So this condition needs to be met. So if the financial years are different, they need to be aligned. So the transferor or transferee has to apply to FTA and get the financial year to end at the same date. Now, the length of the financial year can be different. Could be a shorter period or longer period, like it could be for 18 months or for lesser period than 12 months, but it has to end on the same date. Then the transfer and the transferee, they need to prepare the financial statement using the same accounting standard. So, for example, if one of them is preparing their financial statement under IFRS, but the second one is preparing it under IFRS and for SME, that they are not meeting this condition, they need to bring it to the same accounting standard. For this, they do not need to apply to FTA, and they can just make the accounts to be on the same standard for both the transfer and the transferee. Now, once we have established that before this transfer can take place, the pre-transfer conditions they are being met, all these conditions are being met. So then, and they want to make this qualifying group, then they need to elect to be part of, they need to elect, the transfer needs to elect for qualifying group relief. So once they have elected for this qualifying group relief, and these conditions are being met, then these assets and liability, they can be transferred at book value, and it will be a tax neutral transaction. There will be no gain or loss. So these assets and liabilities that can be transferred under this group relief, they are those that are held under the capital accounts and not the revenue accounts. So those class of assets can be part of this transfer. There is no requirement that any consideration needs to be paid. If any consideration is paid, then we just assume that it is equal to the book value of the transferred asset and liabilities. There is no specific mode of consideration that is given as a condition for this transfer to take place. This consideration can be in cash, it can be in kind as well. So the different types of transactions that can be classified under this transfer of asset, it can be under sale, exchange, relinquishment, sale and leaseback deals, which are treated as sales in accounting standard, exercise of any option to buy or sell assets or liability, transfer under universal title. So these are just some of the examples that can be considered as transfers. Now, but if assets and liabilities are being transferred due to liquidation or merger or dissolution, and which results in the legal cessation of the entity, then this qualifying group relief cannot be enjoyed for such transfers. So after the transfer, so like we had discussed the 7 conditions, those 7 conditions, all of them need to be met, and they need to be met for 2 years. That is the post-transfer phase. That is the requirement, the condition that they need to be followed for 2 years at least, all the conditions, and so that this transfer doesn't become void. So if, for example, the transfer can become void if the transferor or the transferee, one of them, they exit the qualifying group before these 2 years are up from the initial transfer, or these assets or liability which were transferred between the group, because remember, this relief is available because at group level, the ownership doesn't change because it stays with the qualifying group. That is why they're given this benefit that they don't have to deal with the tax impact of the gain or the loss arising out of these transactions. So this is tax neutral only because they're part of the same group. So if one of the entities exiting the group or the asset or liability is being transferred out of the qualifying group before these 2 years are up, so then this relief becomes void and it is not applicable. So now this is what we call a clawback situation. So now if before the 2 years, this relief becomes void and you've already taken the impact of the tax neutral impact at the time when this transfer happened. So then this gain and loss has to be calculated based on the assumption that the initial transfer was not at book value, that it was then at market value at that time. And this gain and loss has to be recorded by the transfer when this clawback is triggered. If the transfer has ceased to exist for any reason, then this must be recorded by the transferee. So that is it for now. So this was just an introduction to the qualifying relief, and what we will do is that we will continue to talk about this guide a little bit more in our future webinars. And if you have any questions for this webinar, feel free to asked. And I think that is it for today. Yeah, I don't think there's any questions in the chat. So thank you very much for joining us. If you have any questions, feel free to email us at info@crestcooper.com. And we will see you hopefully next week. Thank you. So I think we see a question. Will you be sending us a copy of PPT? Please email us at info@crestcooper.com, and we will be happy to share this PPT with you. It will also be uploaded at our YouTube channel, like we said, that with the handle Crest Cooper, so you can also find it there. But please email us, and we will be happy to share this PPT with you. Thank you so much, everyone, for joining.